Equitas was one of the first small savings bank in India, and it's been in the microfinance space for more than 11 years now. The Chennai headquartered financial lender has seen a spike in its share of NPAs in the recent past. Maybe costs have gone up as well, but there are reasons thereof. But to talk about how is the situation now and what could 2018 hold in store, the Managing Director, Mr. P.S. Vasudevan, Johnson, right now on the show. Mr. Vasudevan, thanks for speaking to us at Bloomberg Quint. This is Neeraj Shah here. Good morning. What's the ground level scenario, on various facets? One, how is business momentum looking like? And if you can apprise us of that, then we'll move on to costs and liabilities as well. But how is the business situation looking right now?
Good morning. We are a 10-year-old NBFC. We converted into a bank last year. September 2016 is when we converted into a bank. The post the conversion into a bank, of course, we had the demonetization which came in. Now, demonetization did have an impact on the microfinance collections, specifically in about 3 states, Maharashtra, Uttar Pradesh and Karnataka, to be the specific states, where we had some issue in the collection on microfinance clients. Across the industry, we saw a spike in the NPA of microfinance borrowers. But that's kind of now got settled down post April 2017. We have seen that the microfinance collections have kind of come back to the old levels of typically about 99% plus collection levels. And since then it's been kind of stable. But the impact of those customers who stopped paying during that 3-4 months period, that is obviously having a drag on the profitability. So there's a certain level of provision that all of us have been taking over the last 3-4 quarters. As far as the other products are concerned in Equitas, we had diversified in 2011 itself. We had started our used commercial vehicle finance and then subsequently the micro loan against property for the very small enterprises. So we had diversified and our microfinance was only about 50% in 2016, and today microfinance contributes to about 33% or 34%. We have a slew of other products which we have introduced post becoming a bank. We have introduced agri loans, we have also introduced SME loans, and we have also introduced business loans for the small enterprises. So all these new products have been taking off quite well in the last 1 year. Today the new products are contributing somewhere in the range of about 15% of the total book, and that's expected to go further up as we go by. With of course microfinance having come down from 46% in the beginning of 2017 April to now approximately about 34-35%. In terms of NPAs, microfinance, as I said, minus the chunk of customers who went into a default zone during the demon period, the rest of the segment has been doing quite well, and the portfolio continues to behave very well as far as the rest of the portfolio is concerned. On the non-microfinance book, we did see a spike in the NPA in specifically the used commercial vehicle during the second quarter, but that was largely an effect of the July-August period when the GST was introduced, and there was a certain amount of lull in the freight earnings and freight movement in the country. But that was just a 2-month period, and even in September, I had mentioned earlier that even in September we saw our collection coming back to normal levels, and this quarter continues to be good. So okay.
We'll talk about that as well, Mr. Vasudevan. Your overall GNPA might be slightly higher to peers, but I'll come to that in a bit. Firstly, the asset side. What do you target the overall book growth to be like for FY18 and FY19? And a comment on the LAP, which is now 25% of the book. It's something that at least watchers are a bit uncomfortable with. What's the outlook there?
We have already informed earlier also that this year we expect a growth of about 15% on our total advances. That is in spite of nearly about a 30% drop in the microfinance book, which is a very conscious decision that we have taken. If you take the non-microfinance portfolio, the current year is expected to grow up by something in the range of about 50%. So with a 50% growth in non-MFI book and a 35% drop in the MFI book, that gives me an overall growth of about 15% on the total book for this year. That's what we estimate for March 18. And going forward into the next few years, basically we operate in segments where there is not too much of competition. There is a lot of unserved demand across almost all our product ranges that we have, that we operate in. There is a lot of unmet demand. So generally speaking, the potential is not really the issue. The market demand or the market potential is not really the issue. The issue will always be only one of our ability to manage our portfolio quality. So long as we manage our portfolio quality, the ability to grow is always very high. And traditionally in the last 4 to 5 years, if you see our CAGR, we have been growing approximately around 40-45%. So that level of range of growth, 30 to 40%, is generally not an issue, provided our quality is always held in place. And the second thing that you asked about is the lab. Now, as far as the lab is concerned, actually, our lab segment is very different to what the rest of the market industry plays in. We are really in the very small lab category. We are basically in the 50,000 to 10 lakh rupee category. That's where principally our business has been done in the last few years, last 5 years. And our experience on the lab has been extremely good. And so we don't have any issue as far as our lab book is concerned. It's only the used commercial vehicle where also our NPA has been very good, very comparable to any of the other players in the market. But July, August was an issue, but that was just a 2-month blip based on the GST impact. But now it's kind of back now.
Good morning, Mr. Vasudevan. This is Ira joining in as well. So, from some data that I have from a report in front of me, it looks like it's the business loan segment which is growing the fastest on a sequential basis. And, that makes sense because that was the core purpose of small finance banks to get into the business loan segment. Can you give us a little bit of what the experience there is? Are you lending based on cash flows? Are you lending based on securities? Any sense of what kind of asset quality this particular segment will throw up?
Yeah, so business loan consists of 2 segments. One is the unsecured business loan. The second is the secured business loan. Now, the secured business loan basically goes in the form of a working capital limit, like a CC or a OD facility for the operators. The unsecured is more like a bridge loan, not a bridge loan, but more like a loan which is required to kind of meet some shortfall in the working capital requirement of a company. So both of them have been doing well. We have introduced this nearly about a year back, and both of them have been doing quite well. The growth has been good, and see again, principally we are targeted at the business loan requirements of between 10 lakhs to 50 lakhs. So that continues to be our core focus area. And in that segment, if you see the potential turnover of the customer is typically in the range of maybe about you can say 1 crore to 5 crore or 1 crore to 10 crore kind of a turnover. That's the turnover of the segment of customer that we are focused on. And in that segment, if you see, there's not too many bankers who are really operating very strongly there. Basically because the ticket size is small, so it makes so much more difficult job in terms of identifying them and doing the cash flow assessment, setting up a limit and monitoring the limit, etc. It takes a lot more time and a lot more effort. So we don't see too many banks very active in that segment. And that's where we are seeing a large growth coming in for us, because basically the segment is very large, the demand is very large. And what we call as the neighborhood banking, basically wherever our branch.
So how much of it is unsecured? How much of this business loan segment is unsecured?
Approximately 50%, 45% would be the unsecured component, and balance 50-55% is the secured component.
And you haven't seen any sort of large incidents of defaults in this unsecured part in particular?
See, basically it's only a 1-year-old book.
Yeah, exactly.
Entire book is only 1 year old, so it will take maybe another year for it to really mature. But we have our early indicators and all that, so we track a lot of other indicators. See, our NPA in the unsecured business loan today is hardly anything. It's 0.2%.
Okay.
But then we have other trackers like, let's say, the check bounce ratios, for example. So a check bounce ratio could be a potential indicator of a stress in the future,
Yeah. Okay, sir, got that. So just want to quickly get a sense of what's happening on the liability side. Much noise being made that, all NBFCs and even SFBs which are exposed to the wholesale market could see, upside in cost of funds because of the rising bond yields, etc. Is that actually true, sir?
Well, yeah, of course, the rising yields are there. It's there, right there in the market. So the bulk deposits should start seeing some amount of increase in the cost, and now you will see the yield on NCD is also going up now shortly. So anyone who is exposed to the wholesale borrowing market is bound to see some increase in the cost. In our case, right now, our retail deposit does contribute a significant part of our overall mobilization. as of September, our deposit was about 40% of our total borrowings. Balance 60% still remains the old borrowings which we have to phase out over a period of time. Out of that 40% of deposits that we had as of September, our bulk deposit was somewhere in the range of around 22-23%. So nearly half of our deposit was bulk deposit in September. But our CASA has been growing on a month-on-month basis. We have set up 375 liability branches over the last 1 year. So our CASA and retail deposit traction has been quite good, as we speak. And so the bulk deposit should come down. That will have some benefit in terms of our cost of funds. But yes, to some extent, the fact of rising yield will have an impact on our overall cost of funds. So our cost of funds has been going down over the last few quarters, basically because we are replacing a lot of the old NBFC borrowings with the deposit borrowings. But that yield difference will slightly taper down because some of the deposits come at a higher cost. But if you look at our lending side, as I said earlier, we are lending in segments which are significantly not serviced or not served properly by other paid players. So we are generally never under pressure either in terms of our lending rates or in terms of our LTV or in terms of our credit quality. We are not really under stress, generally speaking.
Got that. So I just had one quick question before we run out of time. So wholesale, I know, is linked, of course, to the market rates, and I'm not sure whether the short end where you borrow has moved up as much as the long end. But your CASA is coming at a higher cost as well because you're offering 6% rates, right, on savings account. Do you think at any stage you'll be able to normalize your CASA cost as well?
See, right now we are offering 6% on savings. Of course, current does not interest rates. And we will probably hold it for some more time because for us the whole challenge is how do we replace the balance 60% of the old NBFC borrowings with the deposits. And the difference is what we are looking at. The faster we ramp up our CASA and the quicker we replace the older and higher cost borrowings, the better it's on our spread perspective. So the whole challenge right now is to build a very strong traction on the retail deposits as well as CASA, and that's the time when your better rates on the savings does help a lot. So I don't think we are going to do a change in our savings interest rate in a hurry, but we'll probably look at it later when we have replaced most of the old borrowings with the CASA and the retail deposit. Maybe that's the time when we start looking at the cost further.
Right. Mr. Vasudevan, I have one last minute. I just wanted two quick updates on numbers. Your GNPA 5.76, is there a chance of that coming down? And two, your cost to income ratio, which went up dramatically, how will it normalize? Very quick, last 1 minute on the show.
Yeah, so the GNPA should improve because, as I said, there was that microfinance had an impact, but that microfinance, the rest of the microfinance book has stabilized now over the last 2 quarters. So there is no more increase in GNPA that either we are seeing or anyone else is seeing on that. So that should help. And second thing, as I said, non-microfinance, the used commercial was the only one which showed a blip in July, August, which is again back to normal. So we should definitely see an improvement as far as that's concerned. And in terms of the cost to income ratio, it was around 83% in September. But if you see our cost of operation, the entire operating cost of 220 crores of second quarter was same as in the first quarter. We have reached a peak as far as our OPEX is concerned. And from here on, it's more in terms of leveraging the OPEX and the infrastructure that they have set up. So hopefully the cost to income should keep going down as we leverage the investment that's been made in the past.
Lovely having you, Mr. Vasudevan. Thank you so much for taking the time out and look forward to talking to you post your quarterly earnings as well. Well, that's Equitas talking about cost of funds.